UiPath Stock, or PATH, Path Stock, is getting crushed today, down nearly 30% on their fourth quarter 2021 results. Let's talk about the results. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. And full disclosure, this is not financial advice. And at the time of this video publication, I did own shares in UiPath, Path Stock. And so look, if you want a download on the business, what do they do? I did a prior video on it asking, hey, is it finally cheap? My conclusion was maybe getting close. The super quick recap of what is UiPath is that they're the leader in the fledgling robotic process automation industry that uses machine vision to help employees at companies automate manual processes. Super quick recap. But my conclusion from the video was that I liked the company, but felt the valuation was still very full, around 28 times annualized recurring revenue, and that the risk environment had changed, making these types of stocks the growth but unprofitable businesses at greater risk. So what's going on now? Seeing this 30% decline, about nearly 30% decline. So as you look at the results, the reality is they're still posting very strong figures. You're talking about nearly 60% growth in annualized recurring revenue, strong global customer base, significant growth in customers that are spending a lot of money with them, over $100,000 in annualized recurring revenue, and a very, very good, best in class, in my opinion, dollar-based net retention rate that's based on the annualized recurring revenue. So why such strong net expansion, net retention? So 145% net ARR retention and 98% growth. Gross, it's worthwhile to understand what do these metrics mean. So 98% gross means effectively you lose 2% of their customer base in a given year in terms of annualized recurring revenue. That is an exceptionally strong and sticky product. The 145% means that if they didn't get any new customers, their annualized recurring revenue would still grow by 45% just from their existing cohort of customers. So very strong figures here. Now, why is it? They talk about customers like T-Mobile start with automating maybe just one function, maybe in finance, something like accounts receivable. Really could be a lot of different things. And then you move on to the whole organization over time as you realize how productive RPA software can be. And they've continued not only to grow within companies, but also to grow their customer base. You can see 10,000 plus, many, a dramatic increase in the large customers that are spending over $100,000. So this product, in my opinion, reflects that they have a strong value proposition, that they are winning market share, and this could be the beginning of a multi-year, potentially multi-decade tailwind. So this is what I like to see. And they're doing this really strong growth with minimal cash burn. It's not bad, not great. Looking at around $55 million in operating cash flow burn in 2022, then factor in a little bit in terms of CapEx, so maybe around 60, 70 million. Now, there was a lot of stock-based compensation. So I do want to see that get better over time without as much dilution. But the reality is they have a very long runway with around $1.9 billion in cash on their balance sheet. So they could easily finance their growth in the quarters and years ahead. It's all about making the machine work. So then why is the stock down so much today? What's sort of the news that's pushing it down? So first, Europe is over 30% of their business. And when they do business, it's priced in the local currency. So as, let's say, the US dollar rallies and capital exits Europe, this hurts the results of UiPath, which reports in US dollar. So you have that. But not only do you have weaker foreign currency, but also increased global business uncertainty. They talk about political uncertainty and rising interest rates. This leads to a weaker outlook for their business. This is a concern, but one could argue this is probably something that you're going to be seeing with a lot more companies. This is also a direct impact. There's this direct impact on the fact that they're pausing their business in Russia, saying, look, here Russia invaded Ukraine. We don't want to get saying we don't want to have problems with our business, so we're pulling our business out of Russia. That's a direct hit to their top line. And so while their revenue outlook is on the soft side, they're talking about only 20% plus growth for their revenue. Their annualized recurring revenue, which is, geared more towards the back half, that, in my opinion, is the metric to follow. That's going to be what's going to drive their real profitability over time. That's how I personally look at valuing it. That's also what management calls it out. They still expect that to grow around 30% plus, which in my opinion is still quite solid. So revenue might be a little bit more lumpy, but by the end of the year, they're still looking at growing annualized recurring revenue by 30%. So that might be a lumpy, throughout the rest of the year, but December to December, annualized recurring revenue their management's still expecting to be quite strong. Now we'll see if they deliver on that. Now that's not all for why the stock has gotten hit. Not only do you have foreign currency impact, you see an impact from Russia, you see an impact from increased business uncertainty, potential recession risks. You see customers less certain to spend money on effectively, innovative and productive resources, tools, but you also see a change in leadership with their chief revenue officer is leaving to pursue other opportunities. This is always a concern whenever you see a hyper growth business and their chief revenue officer, the guy who's in charge of making it rain, leave. And so then you're saying, well, wait a second. What opportunity could be better than this? So it makes you, concerned. Could they be leaving to, let's say, competitors, or are their competitors growing faster? This takes time. For me personally, investing is a long-term journey. So I'm looking at these companies. I'm not going to make a, snap judgment, say, oh, I got to get out of this based on this. I still own my, my position. We'll talk more about that in just a second. But, I'm looking at this and saying, I don't like seeing that the chief revenue officer is out, that they're bringing in a new chief business officer. But look, let's judge the results. Let's judge the fundamentals one quarter at a time. The reality is the fundamentals continue to be quite strong with hypergrowth. The real thing that's hurting a lot of people is valuation. And I pound the table. I've talked about it over and over again. Valuation matters. You should be aware of it. And I'd argue that's been the biggest headwind for UiPath shareholders in the last few quarters. And so what about the current valuation? First, a quick plug. If you're interested in finding new potential multi-baggers, new potential investment ideas, or following along with my personal financial journey, go to unrivaledinvesting.com. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. Once again, that's unrivaledinvesting.com. Click join the journey. I'm interacting on a regular basis if you have questions or companies you want me to look at. So looking at the current price, around $21 a share, around a little under $12 billion market cap. Given their weaker outlook, it's important to adjust the upside potential and assumptions accordingly. I'm still impressed with their execution and growth, and I own a tiny position. Unrivaled Investing Journey subscribers can track, every month I give an update, and you see also on a daily basis what I'm doing. Now, based on the current price and updated potential growth rates and margins, maybe 100% upside over the next 5 years is sort of the upside potential that I'm looking at here, depending on if they can grow, let's say at 25% plus and get to 35% profit margins longer term, and let's say get to around 30 times earnings multiple 5 years out. So effectively saying, hey, this business can continue to execute, continue to grow, continue to prove their value proposition. Ultimately, I'm a believer in RPA software. Will they continue taking share? Will they continue winning? And look, of course, the stock price can definitely go higher or lower. A lot depends on execution and sentiment. Overall, I like what I'm seeing here. That said, I'm very curious to watch them execute in the quarters ahead. I need to see continued fundamental results. I want to see that cash burn improve to free cash flow. Will they continue to prove their strong value proposition? Will they continue to take share? Now, the question is now the time to scale up? The reality is that you're looking at a company that's trading at 10 times forward annualized recurring revenue. It's still not crazy cheap. So I'm going to continue watching it, and we'll continue the conversation on our exclusive Unrivaled Investing Discord server. So I would definitely, welcome feedback here. If you have any thoughts on UiPath, if you think, differently based on the results, or if you're seeing a lot more competition from various different, players out there, I'd love to hear your feedback. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.